Have you ever felt a quiet unease, a gnawing uncertainty as you watched investments, perhaps once celebrated, slowly erode? It's a familiar ache, this feeling that the market is a chaotic sea, its waves crashing with no discernible pattern, leaving us adrift. We see popular stocks rise on a tide of fleeting enthusiasm, only to recede, leaving behind diminished hopes and pressing questions. This sense of inadequacy, of feeling lost amidst arbitrary market movements, is a heavy burden many carry, feeding a deep-seated fear of making costly mistakes. But what if this tumult is merely a veil, a shimmering illusion? What if beneath the surface, a deeper truth, a bedrock of enduring value, awaits discovery? Benjamin Graham, the quiet architect of value investing, once offered a profound compass for this journey. He whispered that in the short run, the market is a voting machine, but in the long run, it is a weighing machine. This analogy, simple yet profound, reveals the fundamental disconnect between fleeting sentiment and enduring substance. Consider this wisdom deeply. The market, in its daily frenzy, often simply tallies opinions, a chorus of passing enthusiasms and sudden fears. It reflects collective emotion, a popularity contest driven by headlines rather than the enduring economic reality that beats at a company's heart. This is the chaotic reflection of short-term speculation, often obscuring the genuine underlying worth of a business. It's what keeps many feeling overwhelmed by the sheer volume of conflicting financial information and noise. The true challenge, then, is not to chase these votes, but to learn how to weigh. How do we, with quiet confidence and data-driven truth, cut through this ceaseless market noise and identify a company's genuine intrinsic worth? How do we find that true value, independent of the daily gyrations that tempt us to stray from our path, fear of making costly investment mistakes looming large? In this journey, we will walk together, exploring three fundamental methods for intrinsic valuation. These are not mere academic exercises, they are profound tools, pathways to informed decision-making and sustainable wealth creation. They are designed to transform confusion into clarity and doubt into decisive, actionable insight. We are uncovering the hidden truths behind wealth accumulation. Don't just invest, understand the why behind every decision. How often have you looked at a stock's price and felt a quiet tug, a belief that this number, this flashing figure, must somehow be its true worth? It's a natural inclination, a deep-seated desire for certainty in a world of flux. Yet, this very trust can be a mirage, a deception woven by the market itself, often leaving us bewildered and prone to costly errors. We feel the frustration of not knowing how to effectively translate theoretical investment knowledge into real-world actionable strategies. For too long, a quiet dogma has whispered in the halls of finance, the efficient market hypothesis. It suggests that all known information is already baked into the price, leaving little room for independent analysis or smart money to gain an edge. This belief, while comforting in its simplicity, often overlooks the most profound factor of all, the human heart, the human mind. We are not perfectly rational machines. Our brains, in their elegant complexity, are also wired for shortcuts that can lead us astray, often appearing as prudence, but hiding an inability to adjust to new data. This is where cognitive dissonance and anchoring bias subtly derail us. That initial price we see, like an anchor drop deep into our minds, can hold us captive, preventing an objective assessment of true business fundamentals. We cling to what we first perceived, even as new information whispers a different story. This emotional cost of believing the market is always right, this reluctance to challenge the consensus, is a profound psychological trap. The herd mentality further inflates bubbles and crash markets, revealing that stock prices are often a reflection of collective fear and greed, not calculated worth. Jesse Livermore, the legendary Great Bear of Wall Street, understood this deception intimately. He wasn't swayed by the roaring crowd or the whispers of consensus. He observed, he analyzed, and he acted on his independent conclusions, often against the tide of market sentiment. His story reveals the critical importance of independent thought and data-driven analysis over market sentiment, and the profound impact of behavioral biases on investment outcomes. To become the analytical skeptic, to gain your edge, means first acknowledging the market's mirage. It means consistently asking, is this price a reflection of true value, or merely the collective fear and greed of the moment? Are you truly seeing the business, or just the market's flickering shadow? A quiet fear often settles in the heart of an investor, the dread of pouring effort into a business lacking true, sustainable advantages. This anxiety stems from watching profits vanish, shareholder value erode, and the promise of growth turn to dust. It's the pain of realizing a company, despite its initial allure, couldn't defend its position, leaving you feeling exposed to financial loss. Warren Buffett offered us a potent image for this defense, the economic moat. This isn't just a recognizable name, it's a deep, structural advantage, like an unbreachable fortress protecting a valuable castle. Think of network effects, where a product grows stronger with each new user, or relentless cost leadership that allows a company to consistently undersell competitors, or high switching costs that bind customers to a service. These are the enduring walls ensuring long-term cash flow stability and protecting intrinsic value. Yet, our very minds can sabotage our ability to critically analyze financial data. We often mistake temporary trends or market fads for genuine moats, preventing us from truly connecting a business's long-term sustainability to its intrinsic worth. It's a cognitive blind spot, making us susceptible to the market's fleeting enthusiasms rather than its foundational truths. To become a moat detective means adopting a practical, data-driven framework. We move beyond mere qualitative assertions, seeking verifiable financial indicators that reveal a company's true protective barriers. This approach allows us to identify, analyze, and even quantify these critical advantages, distinguishing the enduring from the ephemeral. Society often pushes us to chase rapid growth, distorting the image of the independent, data-driven investor. But the wisdom of the moat reminds us to patiently seek out companies with these deep, protective advantages. It is in these well-fortified castles, not fleeting fads, that true compounding returns are forged over decades. Are you building on solid rock or shifting sand? Challenge the consensus. Find your edge. There's a silent fear, a gnawing sense of inadequacy that can surface when we confront the future of an investment. We desire a transparent, data-backed framework, a clear lens through which to project a business's long-term value, yet often feel overwhelmed by the perceived complexity. This unfulfilled need for genuine understanding leaves many feeling adrift, unsure how to truly grasp the enduring worth of a company. A common myth whispers that discounted cash flow, or DCF, is an overly complex academic exercise irrelevant to practical investing. Yet, this method is truly the bedrock of value investing, providing a rational anchor against the relentless volatility of the market. It's not about mathematical wizardry, but about understanding that a business's true worth lies in the cash it can generate over its lifetime, brought back to today's value. Our own internal wiring, the immediate gratification of dopamine from quick trades or popular, rapidly changing metrics, often hinders the disciplined, long-term focus required for effective DCF analysis. This craving for instant reward can pull us away from the patient, deep dive needed to truly understand a company's financial pulse. It's a subtle sabotage to empowered, data-driven decision-making. To discern the genuine underlying mechanisms of complex financial markets, we can approach DCF with a clear three-step technique. First, we learn to thoughtfully forecast a company's free cash flows, peering into its operational heartbeat. Then, we determine the appropriate discount rate, reflecting the risk and opportunity cost of our capital. Finally, we calculate its terminal value, acknowledging its enduring life beyond our explicit forecast period. This process empowers us to connect complex financial theory to practical, profitable application. George Soros, with his reflexivity theory, understood that market perceptions could influence fundamentals, and vice versa. His story reveals the critical importance of independent thought and data-driven analysis over market sentiment. Even when applying complex valuation models like DCF, he reminds us that behavioral biases can profoundly impact investment outcomes, urging us to remain vigilant. With DCF, you're not just investing, you're understanding the *Y* behind every decision. There is a silent fear, a deep distrust that can settle within us when we consider investing in companies whose true financial health remains obscured. The dread of pouring our resources into a business burdened by overvalued assets or undisclosed liabilities, only to watch our capital diminish, is a profound pain. This fear of financial loss stems from the opaque nature of conventional financial reporting, leaving us yearning for clarity. Our minds, in their quest for certainty, often fall prey to confirmation bias. We cling to favorable narratives, interpreting every piece of information through a lens that supports our initial conviction. This often looks like strong conviction, but in truth, it hides an inability to confront contradictory evidence, causing us to ignore critical red flags lurking within a company's balance sheet. We see what we wish to see, rather than what truly is. To truly understand, we must engage in a symbolic exercise, dissecting a company's balance sheet with the precision of a forensic accountant. This act of unpacking and revealing with truth shows us how seemingly small adjustments to asset valuation or liability recognition can dramatically alter a business's intrinsic worth. It's an intimate process, revealing the genuine underlying mechanisms of complex financial markets. Benjamin Graham, the father of value investing, offered us a powerful blueprint for this, the net working capital method. This practical technique allows us to identify deeply undervalued companies, those trading below their liquidation value, offering a built-in margin of safety. It's a profound way to uncover hidden value, like finding a forgotten treasure chest beneath layers of sand. This approach empowers us to make truly informed decisions. Neglecting detailed balance sheet analysis can lead to a deeply wounded financial confidence. When a seemingly stable investment crumbles due to hidden debt or asset impairment, it feels like a house built on sand collapsing without warning. This emotional consequence underscores the vital importance of this forensic work. Are you building on solid solid ground, or are you ignoring the cracks in the foundation? Challenge the consensus. Find your edge. How often have you felt the quiet frustration, the sting of incomplete understanding, when relying solely on common valuation multiples? You glance at a P/E ratio or an EV/EBITDA, perhaps feeling a fleeting sense of clarity, only to find later that these simple numbers led you astray. This superficial financial education, this reliance on metrics without deep context, often leads to misinformed decisions and the quiet ache of potential losses. There's a persistent myth whispering in the markets that valuation multiples like P/E are universal indicators of true value. We must gently debunk this. These seemingly straightforward numbers are far from absolute. They are profoundly distorted by a company's industry, its growth rates, and even the subtle nuances of its accounting policies, transforming them into a multiples mirage that can easily deceive. Our minds, in their quest for simplicity, often fall into a cognitive trap. We compare apples to oranges, using broad multiples without truly adjusting for critical differences in business models, capital structure, or growth prospects. This cognitive factor sabotages our ability to critically analyze financial data, preventing us from discerning the genuine underlying mechanisms of complex financial markets. To cut through this market noise, we need a calibrated multiples framework. This three-step quantitative analysis technique guides us to adjust and interpret valuation multiples with precision. It involves rigorous peer analysis, normalizing for growth differences, and applying quality filters to discern genuine relative value. This process empowers us to move beyond superficial comparisons, revealing the true essence of a company's worth. The fatal mistake for those seeking actionable, rigorously data-backed financial strategies is to apply generic multiples without critical thought. It is akin to using a blunt instrument for delicate surgery, missing the nuanced truth of a company's value. This approach leaves you vulnerable, unable to truly understand the why behind every decision. Are you seeing the mirage, or are you seeking the calibrated truth? Challenge the consensus. Find your edge. We began this journey feeling the quiet unease of a market that often feels arbitrary, a voting machine swayed by fleeting whims. We've since walked through the intricate paths of intrinsic valuation, moving beyond the market's deceptive prices to seek the clarity of a business's true worth. We explored the protective power of economic moats, understood the future's worth through discounted cash flows, and learned to discern the true meaning behind valuation multiples, rather than being ensnared by their mirage. Warren Buffett, with the profound simplicity of a sage, offered us a timeless truth that echoes the entire ethos of this quest. Price is what you pay, value is what you get. This wisdom reminds us that the market's daily pronouncements are merely the price tag, while our diligent analysis uncovers the enduring value beneath. It is the core principle that liberates us from the tyranny of daily fluctuations. There is a quiet strength that blossoms when you learn to trust your own carefully calculated intrinsic value. It is an empowerment born of deep understanding, allowing you to stand firm amidst the market's emotional storms, rather than succumbing to its fleeting whims. This inner conviction is a profound antidote to the fear of making costly investment mistakes, offering a sense of control and independence. The margin of safety, often seen as merely a quantitative buffer, is also a powerful psychological shield. It is a balm against fear in downturns and a guard against overconfidence in upswings. It provides the quiet space needed for reflection, protecting your emotional landscape as much as your capital, allowing you to breathe deeply and make truly informed decisions. Now, I invite you to integrate these valuation methods into the very fabric of your investment philosophy. Let them forge a path of independent, data-driven decisions, leading you not just to financial gains, but to a profound sense of financial mastery and sustainable wealth accumulation. Will you choose to merely observe the market's shifting sands, or will you commit to uncovering the bedrock of true value that lies beneath?